This is Rodney Mogan. And one of the most common questions I get about life insurance, especially uh, cash value life insurance, is how does it really work? And what are some ways to kind of do some different things? So I'm going to make a real quick video here on some different concepts. So the first one is really just how does it work? So think of cash value life insurance as a bucket. And on that bucket, you have an umbrella. The umbrella is going to have your death benefit on there. So it's going to encompass all of that. You are going to put in what they call premium dollars. And those premium dollars are then going to go into that bucket, but a portion of those premium dollars are going to be siphoned off to pay for something called cost of insurance, and depending on the type of policy, fees. So it's going to be siphoned off on there. That is a small amount compared to what is going in there. And over time, what is going to happen is that bucket of money, or that bucket underneath the umbrella, is going to fill up. It can't fill up all the way, because then that is going to cause a problem with taxation on both the death benefit and the cash value, mostly on the cash value. But it's going to start to fill up, which then allows you to do some different things. But before we get there, this is what we need to think about. Is I want to have as much money going into that bucket as possible. Well, how do I do that? Well, you can pay a lot of money, right? But the premium is actually built and designed based on the death benefit. So if you're trying to really solve a death benefit need and you want a lot of cash value, it's not really going to work. What you really want to have is, that's where you have term. Term is going to cover your death benefit need. If you're really trying to get money out of the policy, get as much cash value in there, we want to have as low of a death benefit as possible. However, before you get I only want $1 death benefit and I'll put in $10,000 a year. Before you do that, there is a federal rule. It's under 7702, and it actually states that there are some rules and something called a modified endowment contract, or MEC stipulation. So there has to be some type of corridor between the death benefit and the cash value. And it's different by age, it's different by type of company, there's different tests for it. But basically, think about, in this situation, if this is my death benefit, I've got a hard and fast corridor that has to stay between my death benefit amount and my cash value. Otherwise, I either have to pull cash value out, or I have to increase my death benefit so that there's a corridor that always stays there. So with that, we want to be able to put as much money into the policy without violating that corridor. But that means we have to have some type of death benefit. Now, there's a way we can build that depending on the type of policy. We can blend in some term that can fall off over time, because again, there's different test rules that we can do. So I don't want to get too technical, but we do have some different options there. But sometimes that's why your death benefit might be $250,000 when you really only want it to be $25,000, but because you're funding $15,000, $20,000 a year into it, just based on your age, your health, all that those are the calculations for that corridor. Okay. Now, once you get that money and you've built it up in there, there are different ways that you can pull it out. The first one, and this is the concept you always want to be conscious of, and that is, I call it S to B, that is surrender to basis. And what that means is you've put that money in. So you've put money in. That is your basis, just like anything else. So if you've put in $100,000, you have $100,000 in basis. When you're pulling money out, and one of the advantages of these policies, when you're pulling money out, is you can pull your basis out without being taxed. Okay, because it's your basis, it's your money. Okay. After that, though, hopefully you've been doing it for years. You have your basis, and you probably aren't going to pull your whole basis out in 1 year. You're going to pull it out over time, and you're going to want to do that. Otherwise, that could affect the policy. But you're going to pull it out over time, and as you pull it out over time, you're going to draw down your basis, but you still have your growth, and your growth is still growing in there. That's how the other option, or the next option, is you're going to borrow against the policy. Okay, so you're going to loan. Just like, if you go out to a bank and get a mortgage or whatever, you're not taxed on that income. You're not taxed on this income because you're borrowing against it. However, now we have an additional rule with the policy. Not only do we have the corridor rule to prevent the MEC, but we now have an additional rule where we got to make sure that policy stays in force for your entire life. So we have to have another corridor. So we have the top corridor where we can't cross to avoid the MEC, but now we have basically a bottom line. I know I should use a different color, but a bottom line down there that the policy cannot go below because it's got to pay for this death benefit. So it's got to make sure that death benefit will always be there. Otherwise, you're taxed on all the money you pull out other than your basis. So those are some different things. Now, when you borrow, the way it works is a little different based on the policies. There's a lot of different policies, a lot of different ways to do it. And so, you have to kind of be conscious of those different things. But the most common way, like I said, is pull out your basis and then switch to loans. And then in that bucket that you have, so you picture in that bucket, you still have a small amount here going to cost of insurance. Okay. But then you have this larger spigot that allows you to pull out income. Okay. And again, surrender the basis, switch to loans. You can pull that out. And so you're always going to have, you want to have a little bit of a quarter down there at the bottom. You have your top quarter here. Okay. And then you got cash value that you can pull out. And you can turn this spigot on or off, and it's going to come out income tax free. When you pull it out, after you've done the basis, you're going to have a loan. You're borrowing against the policy. The different companies do it different ways, but essentially it's going to work like this. So you're going to have your spigot that is going to come out to you. But there's going to be kind of a shadow bucket or a shadow account. And again, every company's a little bit different how they do it, but a shadow account or shadow bucket that is, you're going to put money, the loan amount is going to be there. And you're going to earn you're going to get charged interest on that bucket. Okay? Just like a loan. However, your full amount, so if you had $500,000, you borrowed $100,000, technically you got $400,000. You have $100,000 in this bucket, in this shadow account, and you've got $400,000, but technically you've actually have $100,000 in your pocket because you pulled it out. But there's $100,000 number in the shadow bucket that they're going to charge you interest. Let's say 5%. But your account value is going to actually show 500,000 minus 100,000 because you pull out the 100,000. You don't really have that 100,000 in there, but it's going to show it on there. It's going to say loan of 100,000 in there. But you're going to also get interest in this account generally on that 500,000. So if you're getting charged 5% here, let's say you get 5% here, you might have a zero net cost. That's what, when you hear zero net cost, that's what that means. In some policies, you might actually get 6% charged to, interest credited on the 400,000, but only 3%, and you're getting charged 5%, so you have a zero net cost of 2. Again, it's going to depend on the policy. It's going to depend how it works, but those are some different ways. But the thing is you don't necessarily ever have to pay that loan back. You have to be careful. You don't want the policy to lapse. But generally, if you're getting a decent enough performance inside, as well as having it work, you generally don't need to pay it back. And the advantage here is what happens is it will actually reduce the death benefit upon death. So if your death benefit is $1 million, you borrow $300,000, your beneficiaries are going to get $700,000. That's where that loan is being paid back. So that is just an overall overview. If you need anything more, just reach out to me and I'll be more than happy to help.